Tariffs are back in the headlines with Trump now targeting India. What is driving this move and how significant could it be?
Well, Trump's policy towards tariffs is not just about raising revenue for the US economy or the US government, and not just about trying to change the terms of trade for the US economy. It's also about geopolitics too. And in the last several months, I think Trump has become increasingly frustrated with Russia's refusal to negotiate an end to the war in Ukraine. And that is sort of washing over the relationship, or washing over the US's relationship with India, which is Russia's biggest buyer of oil. And I think basically Trump is using the India tariff weapon as a mechanism to get leverage over Russia and to try and force Russia to the negotiating table. But in the meantime, of course, also punish India for buying Russian oil. It's the biggest buyer of Russian oil. It buys twice as much as China. And as a result of that and their refusal, I presume, to sort of change that, that's resulted in an additional 25% sort of punishment beating from Trump. And so as a result, tariffs on Indian exports to the US will be at 50%, which pretty much means that India won't now be exporting any goods to the US at all. Now, that's perhaps important, but not that important to the US, because India is, I think, the 9th or 10th biggest exporter to the US. But the US is India's biggest export customer. And so it is quite important for India. And I think quite clearly, I would imagine that Indian diplomats are beating a path to the White House to try and negotiate a better outcome. So anyway, let's see where that goes. But this is not just about tariffs. This is also about Trump seeking to gain leverage to try and bring the war in Ukraine to an end.
You've said before that the inflation risk of tariffs might be overstated. Do you still feel that way after this announcement?
Yes, I do. I don't think the India-specific tariff announcement is that material for the US. I mean, clearly, it will result in some ripple effects if it remains in place. Of course, Apple's manufacturing infrastructure in India, and other technology companies' manufacturing infrastructure in India, will pose a bit of a challenge, I would imagine, for those businesses. But in the round, I don't think it's material for the US economy and for inflation in the US. Of course, it's not yet clear how Trump's overall tariff package will affect US inflation. But my guess at the start of this whole chapter in international trade developments was that economists were overestimating the impact on headline inflation, and for one specific reason, which was really that markets are competitive. That if there was just a price increase, if you're importing, I used this example actually in a blog note, but if you're importing cars into China into the US from, I don't know, South Korea or Japan, if you just whack 15% or 10%, 15%, I think it is now, on your price, the fact is that you'll sell less cars. So I think companies' first reaction is, we want to maintain market share. Indeed, we want to grow market share. How are we going to do that? We're not going to do that by just putting our prices up. We're going to have to be more intelligent than that. We're going to have to adapt. We're going to have to become more efficient. We're going to have to take cost out of our manufacturing infrastructure. We're going to have to maybe accept a lower margin on sales to the US. These sorts of decisions are the things that make the initial impact less inflationary than I think is sort of anticipated right at the start. So we don't yet know. There is no clarity yet on the impact on inflation. But I am quite surprised that tariffs are showing up in terms of government revenue, but not showing up in the inflation data yet. Now, some economists are saying that's all down to the fact that inventories is being run down, and that sooner or later the impact will flow through the economy. I'm not so sure. I think there will be an impact, but I don't think it will be anything like as material as consensus economics has forecast.
The Bank of England, as we saw yesterday, cut rates by 25 basis points, as you've been saying they would. But the vote, surprisingly, was split. What do you make of that, and where do you think things are heading next?
Right. Well, on the vote itself, I find it very, very hard to reconcile the voting behaviour of a number of the members of the MPC, Catherine Mann in particular, and Hugh Pill, two prominent members of the committee. And I just don't know where they're coming from, frankly. I don't know what they're worried about. I don't really know how they managed to justify their decisions. Catherine Mann, a few meetings ago, was voted for a 50 basis points cut. Since when wage growth has significantly fallen. We know that there was slightly higher inflation in the economy as a result of administered inflation, and isn't a reflection of underlying inflationary growth or inflationary potential in the economy. And yet, this time round, she voted for no change. I just don't know how you go from that 50 basis points cut to no change when the things that you were saying that you were worried about, not least wage growth, have ameliorated significantly. I just don't understand it. I'm obviously pleased that we've seen the 25 basis points cut. One of the members of the committee voted for a 50 basis points cut. He clearly, I think, is more attuned or more aligned with my thinking about the UK economy. But in the end, I'm of the view that you know, the things that I said would happen are likely to continue to sort of map out as I had predicted. So I do think we're going to see another 25 basis points cut in November. And as inflation returns to target in the first half of next year, we'll see further interest rate cuts in the UK. So in a year's time, we could well be looking at rates below 3.5%, maybe even trending to 3%.
The US job numbers were weaker than expected, and bond yields have fallen as well. What is the key takeaway there for markets?
I think this sort of feeds into the debate about when the Fed will be confident enough on the inflation outlook to cut rates. And given their dual mandate, given the prominence of labour market data in the Fed's thinking, I think the bond market's reaction to those weak data is the right one. So basically, you know, the US labour market isn't as strong as people thought. It isn't as strong as the Fed had anticipated. And I think if that trend continues that we saw in the latest release, then I think it's likely that the Fed will cut in September. So, you know, the Fed is cautious, and the chairman of the Fed is particularly, you know, he said repeatedly, we need to see what the inflationary impact of the tariffs are going to be. He will have more clarity in September, but it's my guess that when you think about all the moving parts, I think it's likely that the Fed will cut in September by 25 basis points.
So there was a major court ruling last week on UK motor finance. Why was that such a win for the banks?
I think because investors had been concerned that the motor finance problem might turn into the sort of multi-billion mis-selling problem that has afflicted the UK banks in the past. So I think there was a sort of fear that this was going to be a rerun of the very expensive mis-selling problems that the banks have encountered before.
A rerun of PPI, for example.
Yeah, for example, yes, exactly. That's exactly what people were worried about, which turned out to be tens of billions. I can't remember the exact figure, but it was a huge penalty that rolled on for years and years and was very expensive to administer. So I think there was a fear that this would explode into something very, very big. And so the Supreme Court ruling was very important. And it means that the potential worst case outcome is now removed. Indeed, even median outcomes are now removed. There will be an FCA administered redress scheme for cases where there was egregious commissions. But in the totality of the hit for UK banks from that redress scheme is likely to be significantly lower than I think was discounted across the sector. So Lloyds Bank in particular, benefited significantly on the day. I think the stock was up about 8% on the day of the judgment, which reflects, I think, the relief that the Supreme Court ruled in the way that it did. So it is important for the banks, and I think it wouldn't have undermined the investment case for the UK banking sector at all, even if it was a much worse outcome. But that risk, if you like, has been removed. And so investors got one less thing to worry about, really.
BP's had a busy week as well. A big discovery, some strong results. What stands out the most for you?
Well, I think the discovery is very important. It's the biggest discovery in 25 years for this company. And it's offshore Brazil. It's a very big reserve, I believe. So that's very good news. But probably more important is I think the increasing sort of change of direction, the strategic change of direction that's taking place in BP. BP had under its old leadership really been one of the first energy companies to embark on a diversification, really a fundamental diversification away from fossil fuels towards green and renewable energy. And lots of investors were concerned about that. BP's financial performance has deteriorated whilst that strategy was sort of beginning to be rolled out. It didn't look like, well, investors were concerned that strategy was not going to deliver the outcomes that I think initially supported the decision. And of course, an activist investor turns up on BP's register, Elliott, and they have been pushing for a reversal of that renewable energy strategy to go back to what BP was good at, which was finding fossil fuels, exploiting them, and delivering good returns to its shareholders. So there's been a major change of direction. This has involved a new CEO. The business is looking for a new chairman at the moment, but I think that is the more significant thing going on at BP. The influence of Elliott and I think the disappointing financial results, I think, have been the catalyst to force this change of direction. And BP's got some catching up to do, but I think the future looks a lot brighter than it did a few years ago.
There's another UK company attracting a bit of a bidding war, Spectris. What does that tell you about the UK market right now?
It's an important deal. It's quite a big deal. So at the moment, KKR is in the lead with a £4.8 billion bid for Spectris, and they've outbid Advent, which was the other PE business that had bid for Spectris. I think what this highlights once again is how undervalued the UK stock market is across the board. The premium that now looks like KKR are going to win the bid. That premium is well over 50% over the undisturbed price of Spectris before anybody arrived on the scene. That sort of control premium is way above what one would be used to. I mean, many years ago, when the market wasn't as distressed at such a distressed level, control premium, typically bid premium, would be 25%. That would be a much more normal bid premium. These days, we're seeing bids go out at 50, 75% premium. And I think the extent of those premia reflects the huge undervaluation that UK assets are trading at. I've highlighted this before in previous blogs, and I think bids like Spectris will continue in the UK market. Basically, international buyers, international private equity, international corporates will continue to come and shop for high quality assets in the UK market whilst they trade at ridiculously low valuations.
Some of the AI spending commitments, we talked about this in our last month Q&A, but some of their spending commitments is just huge. I mean, Apple was the latest, committing to spend $600 billion in the US. What's your view? Does any of this change your view on the risk and rewards here?
Look, I've been talking about this for a while now, and I'm just staggered by the numbers. The numbers just keep growing and growing and growing. The growth in capex is vast, but the scale of the capex, if you added up all of those large US tech companies, added up what they're planning to invest in the US economy over the next few years, the numbers are just eye-watering. Now, I think there will be capacity constraints. I'm absolutely sure that not all of that money will be able to be invested as quickly as some of these companies have indicated. I'm convinced that there will be capacity constraints just in terms of the supply of basic things like construction workers, construction equipment. Can the global server industry supply the scale of servers that will be needed in these data centers? I don't think so.
I read just the other week that someone had to tell Mark Zuckerberg that he couldn't spend as much as he wanted to spend because it's just not possible to deploy the amount of capital that he was wanting to deploy. There physically aren't enough chips to buy or infrastructure to purchase. How does that work out in the long run?
Well, I think to some extent we're in a sort of arms race here. I think there's a certain amount of bravado going on. All of those Mag 7 companies and others indeed are sort of trying to outdo each other on the pace of investment. But there's also a fundamental and serious race, if you like, going on as well. The US geopolitically, but also these giant businesses competitively are seeking to sort of take the lead in the AI industrial revolution. They all want to get to AGI and artificial superintelligence, before anybody else does, and they believe that this is an arms race, really, which will be dictated by the scale of your investment and spending. It may well be. I'm not smart enough to know how the winner evolves, who the winner will be, and what scale of investment will be required to deliver that outcome. But what I am convinced about, and I've written about this before, is it's very hard to see what sort of return on investment this gigantic splurge is going to deliver.
OpenAI fired their latest shot just last night with announcing GPT-5, ChatGPT-5 is now available. I've been playing around with it this morning and it's incredible. But how does this move from these companies trying to outdo each other into an investor return? Do we have any sight of how any of these companies are going to make serious money?
It's very hard to see how this translates into a return. People like Elon Musk are telling me that AI is going to dominate our future. He's very bullish about Grok. He thinks it's the leading AI globally by a margin. Some of the things he's claimed about Grok are frightening already.
It certainly seems to be the least constrained. It seems to have the fewest number of guardrails. Which is certainly interesting.
It is incredible what's going on, but bringing my sort of multiple year experience to play here, I just cannot. There is no clarity about what this revolution will deliver in terms of returns. I'm sure there will be a huge shake-up in how the economic cake gets shared between the companies that dominate and the customers of the customers who pay for AI. That has yet to evolve, really. But one thing I am absolutely convinced about, before we get to the point where we can make a judgment about returns, the fact is that these capacity constraints are very significant. And the biggest capacity constraint of all is energy. These are very energy intensive bits of infrastructure. And the US energy infrastructure cannot cope with these increasing demands. So new energy infrastructure has to be constructed before all of these giant data centers can get up and running. And if that means that nuclear power stations have to be built alongside them, clearly there will be the sort of critical path will be dictated by how quickly the US's energy infrastructure can grow to accommodate the extra demand that all of these data centers will impose on it. So My view is that although the Mag 7 population of companies and their immediate peer group are very, very keen to spend money very quickly, they will be constrained by the US's energy infrastructure, and that will inevitably slow down. It will slow the sort of race to deliver dominance in this amazing new technology.
Next week, there's a lot of economic data, both in the UK and the US. Which data points are you watching most closely?
Yes, it's going to be a busy week next week for economic data. Less busy from a corporate results point of view. For me, perhaps the most important data, as far as the UK is concerned, will probably be GDP data. That's the thing that will attract the most attention. If it's a weak number, it will just fan the flames of the current debate about the fiscal challenges confronting the Labour government. I will be writing about those fiscal challenges next week. I think there's an interesting perspective which the media are just not picking up on at the moment. So that will be very important from the UK. But probably the most important data series will be the US labour market data, because I think that feeds into the confidence that the market will have or not have in interest rate cuts in September. And that will probably be the most important thing sort of in the near term that will drive investor sentiment.
Thank you, Neil. That is everything from this week's update. Neil obviously will keep tracking all of the company news, all of the market data that matters for the 4.0 strategies. And we will speak to you at the same time again next week. Thank you very much for watching, and goodbye.